Hello students and welcome to the lecture. So students, as we know that we are covering the financial system, alright? And basically in the financial system, we had started the topic of mutual funds, right? We had started the discussion over the mutual funds and you could say that these are the topics we have scheduled for the discussion under this heading, okay? Like you could say the introduction part, okay? Then the basic history, then the growth of the mutual fund industries, types of mutual funds, regulations, investors' participation, and the conclusion. Okay, out of these, we have completed the introduction, basic history, growth of mutual funds. All right, the topics we are left with is types of mutual funds, regulations, investors' participation, and the conclusion. Okay, so about the growth of the mutual funds, you could say that we were discussing in the previous lecture also. All right. I hope that you have revised the previous lectures in the well enough manner before you have come for this lecture. As so many times I have reminded you that it is for your own benefit. So if you are doing this, then that will be the beneficial for you. If you are not doing this, then God knows what will happen with you. Okay. So let's start from where we had, you can say, ended up in the last lecture. So the mutual fund industry has expanded its distribution network to reach a larger investor base. We had, you could say, started this in the ending of the previous lecture. All right. And we were discussing like when it was starting in the 1963, then it came 2014 and from 2014 onwards till now. Okay. The mutual fund industries have been on the continuous growth. It means that it is including and merging more and more people into the basis. All right. So how did it do this? That is the main thing which we are required to find out. All right. So first is the tie up with the banks and the financial institutions to distribute mutual fund products through their branches and the online platforms. Okay. So if we try to break it down, then what happened? Like 1963 to 87. All right. That was the time when only the Unit Trust of India, Unit Trust of India, also known as the UTI, was in the picture of the mutual fund industry. Okay. Or you could call it like the single entity was there in the market or in the outer field, which was, you can say, inviting the investors and facilitating the mutual fund. Okay. Then we had seen that 1987 till 1993, 1993 till 2003. Okay. What happened during this time period? Now it's a question for you. Okay, I am providing you 10 seconds to think and answer. Then I will give you the answer. And your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Time's up. Basically, I had provided you 10 seconds, but I had also provided you 5 seconds buffer. So I think that it will very, very plenty of time which I have provided you. So basically 1987 to the 1993, the government has permitted the public banks and financial institutions to enter into the market, right? We had permitted them. Got it? All right. And after the new economic policy in 1993-2003, what happened? Like the private banks were allowed to come into the market, okay, and participate into the mutual fund industry. All of these things we had, you could say, that discussed and we had, you could say, understood. All right. So basically, that was the time when not only the UTI, the single entity was not there, but also the public banks and the financial institutions and the private banks came into the market. Okay. So during this time period, what generally happens, or you can say the asset management companies, okay, which you could say these are the generally the mother of the mutual funds, okay, and you can say they are the custodian of the mutual funds and they manages the funds and the assets on the behalf of the client, or you can say on the behalf of the fund members. Okay. These companies now started tying up with the public banks, financial institutions and private banks. Okay. Why? So that they could promote it through their branches and the online platforms. All right. Like if you are using the modern banking techniques nowadays, okay, if you have visited the branches and all the things, so might be there are chances that you have maybe encountered with the mutual fund schemes. If you are using online, then there will be a virtual ad. If you are going to the branches, then might be you see the brochure or the poster and any kind of such kind of things. All right. So basically, this is the thing. Like the AMCs tied up with the banks and the financial institutions, okay, so that they could promote their fund products through their branches and the online platforms. All right. So that more and more people could be benefited through the mutual fund. Why? Because when the people see it, they will try to find it. And when they find it, they will try to participate in it. And this will bring us the glory of the mutual funds. All right. So that's the thing. All right. Collaboration with independent financial advisors and the distributors to promote mutual fund investment. Not only the large public and the private institutes, or you can say the banking companies, they had tied up with, they also, you could say, tied up with the independent financial advisors and the distributors. All right. Like you could say these are the mainly the chartered accountants. Okay. Chartered accountants, or you could say these are the professionals who have obtained their studies into the financial fields, economics, and whatever. All right. So these people are also be the partner of the AMCs to promote the mutual fund investments. Okay. Got it? Direct online platforms offered by the AMCs companies that allow investors to invest in mutual funds without going through intermediaries. Like when we talk about the collaboration, for suppose this is an AMC, any asset management company. All right. This is the group of investors. All right. In the mid of it, there is a intermediator. This intermediator could be anyone, maybe the bank, maybe the financial institution, bank, maybe the public or the private, the individual financial advisor, distributor, whatsoever. All right. So because they are promoting the schemes running by the AMCs. So it means that they are entitled to get some charges or fees. All right. And because they are you can say making the bridge between the AMC and the group of investors, so that's why they will also charges fees from the group of investors. It means that if you want to participate into the AMC scheme, so you have to contact with the intermediary will connect it to the AMC, and whenever the AMC will provide you the return, then the intermediary will charge some fees, then the remaining amount will be sent to the investors. All right. So this is called the intermediation method. Okay. Intermediation method. So this is a very good method in itself, but there is a one problem. Why? Because when we go with the charges or the fee, all right, then it is not so good idea from the AMC point of view as well as from the group of investors point of view. And why I'm saying this? Because if you go with the AMC, then suppose the charges and the fee they are paying, it means that this is their expenditure. For group of investors, the charges and fee reducing their returns. For example, if the person in the group of investors is entitled to receive rupees 10,000 from the AMC by his investment, but the intermediator has put up the 10% charges or fee, okay, then it means that only rupees 9,000 will be provided to the group of investors, or you can say the single individual from the group of investors. Why? Because 1,000 as a 10% of 10,000 will be deducted by the intermediator in the name of charges or fee. All right. So to counter this situation, or you can say to bypass this, what generally happens? Like this is the asset management company, AMC. This is the group of investors. All right. So instead of making some bridge, AMCs establish the direct contact with the group of investors. It means that there will be no kind of intermediary charges and fees. Why? Because now there is no intermediator between the AMC and the group of investors. Got it? So they have overcome this kind of situation. All right. Awareness campaign and the investors education programs to educate investors about the benefits of the mutual fund investments and the various investment options available to them. Okay. Basically, if we talk about it, then there are two main things. If you want to persuade someone towards some place or towards something, first is the benefits explanation. Second is available options. Okay, these are the two things which should be, you can say, available to the investors. Benefits explanation, what does it mean? It means that the person who could be the investor, okay, he has the potential. First of all, the company or you can say the promoter is required to explain the benefits to him. Like what could be the benefit if you invest in the mutual funds, how much return you will get it, how you could diversify your savings and this and that. All right. Available option. Suppose only one option you are providing. The person who could be the investor in the nearby future is, you can say, not agree with your option. He's not willing to invest in it. What will happen? The investor will not come to you, right? So that's why multiple options must be provided. Okay. So that's how the chances of conversion from potential investor to the actual investors could be goes. All right. So this is a thing. After finishing the growth of the mutual fund industry, now we have to start with the types of the mutual funds. First is the equity types. Equity funds primarily invest in stocks or shares of companies. These funds are suitable for investors seeking capital appreciation over the long time. All right. So basically, this is what we had already discussed, that the equity funds provides the ownership in the organization, thus makes investor vulnerable for bearing losses or eligible to get profit returns. Right? That's what we had discussed, that the equity fund generally gives the ownership in the organization, thus make the investor vulnerable for bearing losses or eligible to get profit returns. All right. And this is long term. Why? Because you have become the partner of the company, or you can say you have obtained the ownership in the company. You are not entitled to get the what? To get the fixed return. Maybe you have to bear the losses or you have to enjoy the returns. All right. So there are the types of equity funds, like the large cap funds. What do you mean by them? Let's understand. These funds invest in the large, well-established companies with a track record of stable performance. Okay. These funds invest in mid-sized companies with the potential for growth. Okay, like we could say, suppose there are companies like the XYZ, like the ABC. All right. XYZ having the worth of 100 crores. Sorry, 1000 crores. ABC having the worth of 100 crores. Okay. So if you see the net worth, what you are getting inside your head, that this is the large organization. Got it? This is the mid organization. All right. So when we go with the XYZ, it means that suppose the XYZ has launched the share of 300 crores at 3 crores each. It means that total shares will be 100 shares. All right. Whereas the ABC has issued 50 crores at 1 crores each. It means that total shares value will be 50 shares, right? Or now, suppose you having the fund of 100 crores. 100 crores funds you are having. So now it's a choice of you. Whether you want to buy the 300 crores equity or you could divide it, then it will be like 30% equity in the XYZ. And when you divide it, so 50% equity in the ABC. So it's totally depend upon you. Okay, whether do you want to go? Like if you want to have the, you can say the high potential of growth, or not high potential of growth. You could say if you want to have the stable growth, you want to you can say you do not want to bear the large losses and the risk. So definitely you should go to the 30% equity. Why? Because generally the well stable companies having the potential to be the stable. All right. So there will be a less fluctuations. Why? It is already the stable company. Okay. But somehow if you do not want to invest the entire amount of the fund into only one bucket, it means that you are not willingly to invest your entire amount into the XYZ. So you could go with the 50% equity. It means that you are only required to pay 50 crores and the rest 50 crores you could invest somewhere else. All right. So that's how the large and the mid cap work. If you are investing in the large organization, that will be the part of large cap. Investing into the mid organization, that will be the part of mid cap. Got it? Small cap funds. What do you mean by this? These funds invest in small companies with high growth potential but higher risk. Okay. Like if we talk about the small companies, suppose this is a company. All right. This is a company. All right. This is a company. All right. XYZ, ABC, PQR. XYZ total wealth is 1000 crores. ABC, not 100 crores, just make it 500 crores. $100 crores. Okay. Now I'm not going to tell you which is the large company, mid company or small company. By yourself, you could conclude it. That if it's 100 crores, 1000 crores, it will be a large organization. Right? 500 crores, it will be the mid organization. 100 crores, it will be the small organization. All right. So how much shares it has launched? 300 crores. It means 100 shares at the rate 3 crores each. Okay. 500 crores. It means that 250 crores they had launched. Okay. 25 shares at 10 crores each. All right. 100 crores. It means that suppose 50 crore shares they have launched, which means 10 shares at 5 crores each. All right. Total fund amount right now you having only you could say, let's suppose 300 crores total amount you are having. All right, this is the total fund amount you are holding right now in your mutual fund. Now the choice is yours, whether you want to the large organization, whether you want to go to the mid organization, whether you want to go to the small organization. Okay, like if you go to the large organization, there will be the stability, but the returns will be lesser. Why? Because it has already established. It means that it has already you can say utilized its growth potential. When you go to the mid organization, first of all, the shares value will be less, so that you have to invest the less. Second, returns may be higher. But you go to the small organization, the share value which you are required to invest is much lower in comparison with the others two. Second, the returns will be high because right now it is in the growing phase. It means that it haven't utilized its growth potential up to the fullest. All right, it means that there is a chances that the company will grow further. Got it? But the second thing here is that there will be a high risk associated. Why? Because this is a small organization. This does not having the capacity to bear the high losses. Even this organization is nowadays is just struggling to establish. All right, it is not the well established one. It means that if you buys the equity, or you can say if you buy the ownership in the PQR, then you become entitled to get the high returns, but also to bear the high risk. All right. So basically, it's totally depend upon the funds, or you can say the fund members and the investors, where they want to go. If they want to go to the stability, the large organization, slightly higher returns, mid organization, higher returns, but high risk, they could go to the small organization. Okay. So that's how the system works. Diversify equity funds. These funds invest across companies of different sizes and sectors to achieve diversification and reduce risk. Okay, like if we talk about the all of them, first is the large cap funds, right? Second is the mid cap funds. Okay, thereafter the small cap funds. All right, and here comes the diversified funds. All right, so this is only for the large organizations. Okay, only for the mid-size organizations. Okay, only for the small organizations, but this is for all large, mid and small. Okay, that's why it is called the diversified funds. Why? Because in this you are not required to put your entire investment into the one cap, but you could diversify it. Suppose if you having the 100 crores amount at your fund. Okay, so for example 50 you have invested into the large cap. Okay, rest 25 you have invested into the mid cap, and the rest 25 you have invested into the small one. Okay, so here your entire amount haven't been invested into any of them, but all of them. All right, so this is the benefit of the diversified funds, because from somewhere it will get you the stability, slightly high returns, but high risk also. Okay, so that's how the diversified equity funds work. Now, debt funds. Debt funds primarily invest in the fixed income securities such as government bonds, corporate bonds, money market instruments. These funds are suitable for investors seeking regular income and the capital preservation. Like as we had discussed, debt instruments, these instruments does not provide any kind of ownership in any organization, but only provide shareholding and fixed return. Okay, that instrument does not provide any kind of ownership in any organization, but only provide the shareholding and the fixed returns. It means that you only got the title of the shareholder, but you are not entitled to get any kind of high returns, lower risk whatsoever. Okay, what will be the fixed return? You will entitled to get it. And the instruments like the government bonds, okay, like the corporate bonds and the money market instruments. Okay, so the first is the liquid funds. These funds invest very short-term debt securities with a maturity up to 91 days, offering high liquidity and low risk. Basically, in the equity funds, the diversification start with the type of an organization. Okay, like which type of organization is that in which you are investing. But in the debt funds, it's basically depend upon the time period. All right, like for how much time you have invested your amount. Like if we talk about the liquid funds, okay, liquid funds simply means that it is a very short term debt securities with a maturity up to 91 days, offering high liquidity and low risk. It means that suppose if you have bought a, you can say the not gen, okay, you could say suppose if you have bought the shares, okay, or the securities from your debt, from your fund, okay, so that will be only for the 3 months, or you can say 90 days. The time period when the 90 days will be over, at 91st days, you will get your amount back, okay, and you are entitled to get the returns on it, right? So that's why it is known as the higher liquidity, and because the amount has been invested for the shorter time period, then that's why it is having the low risk capacity also. Short-term funds. These funds invest in debt securities with a maturity of 1 to 3 years, offering a balance of risk and return. All right, like you could see that in these funds, you are investing the amount for slighter high period. Okay, so that's why risk may be increased. Maybe the organization in which you have invested your amount during these years, the organization is not performing well, it is in the loss whatsoever. Okay, so maybe your returns will not come back to you. Okay, but second word which we could see here is the return. What do you mean by return? Because the securities in the debt instruments having the fixed return, it means that for 1 to 3 years you are not entitled to veer up the risk, you will get your returns on the fixed basis. So that's known as the short-term funds. Okay, income funds. These funds invest in a mix of government and the corporate bonds to provide regular income and the moderate risk. Okay, like as we had discussed, the government bonds generally offer the regular income because the chances of being default is very, very low, or you can say almost negligible. But when we come to the corporate bonds, because these bonds are not backed by the government but backed by the issuer or the corporates, that's why they having the, you can say, moderate risk factor. Okay, but also they having the possibility of high returns, because the government will always provide you the fixed return which was promised while purchasing of the bond. But in the corporate bonds, the returns could be increased in the further course. They will not go down, but maybe go up. All right. Gilt funds. Always remember, gilt here is refers the securities of government. Okay. These funds invest in the government securities and carry low credit risk but are sensitive to interest rate changes. All right. Because whatsoever the interest rate the government will decide, on that interest rate you will be eligible to get the return. So students, basically in this lecture we have finished till now. In the next lecture we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture. And what do we say? We say thank you.